Hi, I'm Stephen Glagola, Cowen's cryptocurrency and digital assets equity research analyst, and thank you for joining us for a panel discussion today on what does the future hold for Bitcoin mining, mergers and acquisitions, consolidation, and delistings. We are grateful to have with us Fred Thiel, CEO, Marathon Digital Holdings, Jaime Leverton, CEO, Hut 8, Chase Lochmiller, CEO and co-founder, Crusoe Energy, and Carson Smith, CEO, SBI Crypto. And I just realized I just stated the exact introductions over again. So thank you. I'm going to briefly stay with 60 seconds here, give a little crash course on Bitcoin mining economics, just so we have our terms defined for the audience as I ask these questions. So miners are exposed on revenue to hash price, which is the interplay of daily miner revenue on the numerator divided by network hash rate. And daily miner revenue is mainly a function of Bitcoin price, but also incorporates the total rewards and transaction fees. And hash rate is just the speed at which a miner can produce computations expressed in hashes per second. We've seen that essentially, we've seen the Bitcoin price obviously draw down, we've seen network hash rate go up, and we've also seen on the cost of energy, which is the largest input for these miners on the cost side, go up. So it's been, economic environment has been challenging to say the least. So with that, let's start it off just discussing, the current economic environment for miners, how each of your companies, are positioned. How does this crypto winter compare or contrast, to the prior for Bitcoin miners? And let's just start with Carson, and we'll go down.
Okay. Testing. So I think in this market, or in the current environment for Bitcoin miners, we're seeing a typical repeat of cycles of the previous Bitcoin cycles, which have typically been around 4 years. And these cycles too are not just unique to Bitcoin mining, but are commonly seen in mini markets. And what we're seeing now is mini miners who were over leveraged or turned on or set up mining at a higher cost of energy, at higher cost for OPEX, or they paid higher cost for CAPEX to buy the Bitcoin miners that they invest in their sites. We also saw the last 2 years has kind of been a shock to supply and demand. Supply has been shocked through the COVID pandemic. Shipping has been a typical problem for many industries, as well as production for semiconductor chips and other supplies needed to build the infrastructure for Bitcoin miners. As well as the demand, though, has also been high, given the price of Bitcoin until this year, of course, was drastically increasing. And this increased the demand for energy, the demand for Bitcoin miners, and the demand for infrastructure. And so a number of miners too have over-leveraged themselves. And so we're seeing too some of that deleverage and level out. And I think we'll continue to see that over the next few months. We saw that in the previous cycle after 2017 when the price of Bitcoin came down. It took about a year before hash rate started decreasing, and some of the miners, we started seeing some consolidation there. And so taking lessons from that, at SBI Crypto, we have been fairly patient in the expansion that we've done for our operations over the past 2 years. We expanded quite a bit in 2019 and 2020, but over the last 2 years, we've been fairly conservative in that approach. We have done investments into other companies such as Lancium in Texas, who are working on developing infrastructure and solutions to unique issues. Fred Thiel talked about it just in his keynote speech a minute ago. Some of those issues are dealing, for example, with intermittent wind energy or intermittent solar, and how Bitcoin mining can be used to solve the problems that those cause, as well as to create a more sustainable future for energy production and for Bitcoin mining.
That's great. I think Carson did a great job sort of summarizing a lot of the big macro effects that have impacted the Bitcoin mining business more broadly. I think the story's really been two things. One is operational efficiency, and the second is financial responsibility. The industry sort of discovered leverage, it seemed like, for the first time, and people got overly exuberant about levering up their balance sheet, borrowing money in dollars, holding a lot of Bitcoin on their balance sheet, and then producing Bitcoin as a commodity-priced revenue stream. And so obviously when we saw, 75, 80% drawdown in overall Bitcoin price, that definitely impacts the top line operational revenue of a lot of these Bitcoin miners. And I think the story that's maybe not told enough is actually how the operational efficiency has contributed to this as well, with the pressures on global power prices driven by the geopolitical conflicts in Russia and Ukraine have driven up power prices in areas that had historically had very cheap power, but when natural gas is trading at $9 an MCF at Henry Hub, that market climate shifted pretty rapidly. At Crusoe Energy, we're focused. Our core mission is to align the future of computing with the future of the climate. Really focused on tackling large-scale computing problems, Bitcoin mining amongst those. But we also have a high-performance computing full-service cloud platform to enable things like AI research, rendering, and scientific computing. But one of the primary ways in which we build our operations is that we capture waste methane that Fred talked about in his keynote there. Primarily, that's associated gas that's produced from oil and gas facilities, from oil wells, and that associated gas often can't get to a market where it can be sold or consumed. So operators often just flare that gas on location, creating a very large emission source, which is composed of CO2 and methane. That single source of emissions, just to put it in numbers for you guys, it's about 14.5 billion cubic feet a day that get flared with no beneficial use. As a greenhouse gas, footprint, it accounts for about 2% of humanity's global greenhouse gas footprint. So it's a really, really, really big impact. And at Crusoe, our solution to that is basically co-locating mobile modular data centers alongside that waste methane stream. And by using our digital flare mitigation technology, we're actually able to get a full combustion of that methane and eliminating 70% of the greenhouse gas emission footprint from that otherwise waste energy stream. Additionally, we're able to sort of capture a beneficial use and alleviate some of the downstream grid constraints. So the unique parts of our business that have sort of influenced this in this crypto downturn is that by producing power ourselves, we're actually not subject to a lot of these commodity price pressures that many other miners have seen on the operating side. We pay very little for the gas because it's a waste product, and even when Henry Hub pricing went to $9, our contracts are still very, very low price. So we were already at sort of the low end of the global overall power production, and now that gap has widened substantially as market price-based power mining operations have been subject to a lot of significant operating expense pressure. So.
Thanks, Chase. So at Hut 8, we have a bit of an advantage in that we first went public in the last bull market, survived the bear market, and then we're really in a position in the most recent bull market to use that as an opportunity to prepare properly for the next cycle. So we've been holding Bitcoin on balance sheet since our inception in 2018, and we've now been able to build one of the largest stacks of self-mined Bitcoin of any public company in the world on our balance sheet, and so far have been able to keep that stack unencumbered. We also really focused on diversifying the business, so adding incremental revenue streams that aren't directly related to Bitcoin mining directly. So in our case, we stood up a repair center. So we repair microBT equipment for miners from across North America and Northern Europe. We also, at the end of January of this past year, closed on the acquisition of a traditional data center business. So we now have 5 data centers across Canada, and through those data centers, we service customers from a variety of different industries with co-location, cloud, managed services, and that is allowing us to have an infrastructure that we're building out new bespoke products and services also to help fuel the Web3 ecosystem. So I think we all have different business models, but certainly for the miners that continue to have strength in this market, it's generally about really, really good operating processes and excellent balance sheet and treasury management, I would say.
And Fred, thank you, Jaime, and Fred, before you go, can you maybe touch on too, along with just how Marathon's positioned, but just for the audience, I mean, this is a global competitive playing field, and there is a question mark on only 20 to 25% of the hash rate is public, and so we know kind of where those miners sit on the distribution curve of cost, but we don't know where the other 75, excuse me, to 80% largely sit. It's less transparency there. So maybe also touching on how you see the global competitive playing field as well, that'd be great. Thanks.
Sure. So I think a lot of people have talked about the dynamics of the industry, but you can think of it that today's a perfect storm. You have low commodity pricing, high operations costs because power prices have gone up, and an equity market and capital market that doesn't want to give anybody money in the space. So if you wanted to expand and you wanted to borrow money to do it, you're going to be paying double-digit interest rates. If you need to finance equipment, you're going to pay double-digit interest rates on that. And if you want to raise equity, good luck. Marathon was born prior to the last winter. We started our mining operations in 2018, prior to the last, kind of right in the midst of the last winter. In 2020, when the capital markets kind of opened up, we were able to raise a significant amount of capital, raised over $700 million in 2020, and then over $1 billion last year. And so today, Marathon is a company with very little debt. We have a convertible bond that's about $750 million of debt that matures in 2026 at 1% interest rate. And other than that, just a small revolver that we use for daily operations. None of our machines are financed, they're all paid for, and we're in the process of scaling our operations about sixfold from the beginning of this year to mid next year. At which point we'll be one of the largest self-miners in the world. And like Jaime, we hold our Bitcoin and are amongst the largest holders in the world in Bitcoin. Our philosophy as we kind of look at the marketplace is winter is a time for building, machine prices drop down, hosting prices drop down. But this business is becoming very much more about controlling your energy cost and your power costs. And one of the things we've done on the efficiency side is by mid next year, 66% of our fleet will be operating at about an average of 21 to 22 joules per terahash. Our whole fleet, all 23 exahash, will be at an average of 26 joules per exahash, or per terahash, sorry. Think you could say watts if you wanted to, it's almost the same thing. The average miner out there, to get to the international piece, operates today at an efficiency of about 43 or 44 joules per terahash. That means our fleet operates using half the amount of energy as the average fleet. That has a huge impact on your power cost. And if you look today, you'll see that of the 4 million more or less mining rigs that are installed out in the field, as of the beginning of this year, 28% of those miners were a combination of S9s and S17s, which are mining rigs that today are totally unprofitable to operate. And so miners have had to swap those out. A lot of those miners sit in places like Kazakhstan. They sit in Russia, Iran, Venezuela, other countries like that. And where you have free energy because either the government controls it or the government's involved in the mining, you might still be able to operate those machines marginally. But why in the midst of winter is the global hash rate growing so fast? And what's happening is you have a lot of these older machines are being upgraded and replaced with new machines. Why? The new machines cost pennies on the dollar today because there's just a glut of machinery because nobody's buying anything because nobody has the capital to buy anything. And so you're seeing upgrades of machine fleets around the world, which is causing the global hash rate to go up. But it's really interesting. A $800 drop in the price of Bitcoin from about 17,000 down to 16.2, and now we're at about 15.6, 15.7. The global hash rate difficulty adjusts every 2 weeks. We've had subsequent kind of 5, 6, 8, 9% increases. We're going to see a 10% decrease at the next adjustment, and potentially a further decrease below that. That is the global blockchain rebalancing itself due to costs. But if you look outside of the US, you're predominantly seeing energy sources that are either heavy fossil fuel, such as in Kazakhstan, where you have a lot of coal. You're seeing places like in Russia, where you have nuclear and hydro. Iran has access to hydro, for example. Venezuela has hydro energy. And so you're seeing a lot of energy going into this business. And while the US will likely grow to about 39% market share of the global hash rate, there's still a ton of mining going on internationally. We personally believe the Middle East is a region ideal for Bitcoin mining now that immersion technology is very well proven. We also believe that South America, Paraguay, countries where you have access to stranded hydro energy and solar energy are very attractive. And we think you're going to see the international markets grow very dramatically. Now is a great time to build, and you're seeing investment groups going in and investing heavily in Bitcoin mining when it's inexpensive to build.
Thanks, Fred. And that's a top of mind question I get from investors on just, why is the network hash rate growing in the midst of a very depressed hash price? Moving on from that, we want to touch on M&A here. Jaime, in the current macro environment, how do you see consolidation evolving for public miners? Do you expect it to come via, outright acquisitions or mergers of entire companies, or through parts of companies, or just separate purchases of mining rigs and infrastructure?
Probably all of the above is the answer. We did see a very high number of miners come to the public markets in the last bull run. In North America alone, I think at peak count, we had about 40 publicly traded Bitcoin miners, which is a lot. We have seen, so far in the cycle, we've seen very little outright M&A, a couple small transactions. We haven't seen any public-to-public deals. We've seen a lot of asset pickups, which I think we'll continue to see. As Fred alluded to, the machine price has come down significantly. Kind of peak spot was close to $100 a terahash. We're now sitting around 14, 15. I don't know if my panel mates want to guess where it's going, but I think we could see somewhere between $8 and $10 a terahash when we hit the peak bottom. So I think we'll see increased consolidation in the space. It's really just gotten started with a few bankruptcies, but we know we have some highly leveraged folks in the space that haven't yet got all the way to Chapter 11, but we expect if economics don't change significantly in the very, very short term, we'll see those bankruptcies take place.
And Chase, I'd like you to touch on too here, just the current desire of companies that aren't currently necessarily involved in Bitcoin mining. I'm thinking energy companies, other data center companies, to become Bitcoin mining operators. And I think you're uniquely positioned to talk on this, just given Crusoe is working with Exxon in North Dakota on a pilot project there. So just throw that to you.
Yeah, so I think what's fascinating about Bitcoin is, there's obviously the beauty of it being this open and permissionless global monetary ecosystem, but it's an incredible technology because it's literally money that's backed by energy and technology. And it sort of sits at that, very, very unique intersection of energy and technology. And, to me, I think the future of Bitcoin really is this convergence of traditional energy producers and traditional energy companies alongside, new technology providers like, the folks sitting on stage with me today. And, we, in sort of our core business of eliminating routine flaring in the oil field with both Bitcoin mining and high-performance computing. We've had the fortune to work with some, very large global energy companies like Exxon. We've also been focused on expanding here in the MENA region. I think Fred mentioned this, but I think this area of the world is very, very ripe to play a large role in this new global monetary ecosystem, just given the energy-rich nature of the region. I mentioned earlier about how we help eliminate routine flaring. 38% of the world's flaring happens in the MENA region, and that's a major waste. It's a major emissions resource. It's call it about 0.4 gigatons, so like 400 megatons of CO2 equivalent emissions just from that one source of emissions here in the region. So it's a really meaningful opportunity to both empower this new economy as well as reduce emissions. So our focus early on is going to be on expanding our operations in Oman and in Abu Dhabi, and we're working with leading energy producers in each of those nations, and we're really excited to help bring this new technology to the region.
Thanks, Chase. And Carson, turning to you, big topic of conversation that will probably be on investors' mind as we get into next year will be the halving of 2024 in the spring of 2024, which all else equal cuts the hash price in half. I guess, Carson, let me talk on that. If around consolidation, how do you expect the halving to impact consolidation? Will it look the same in that environment, or will there be a spur to have some type of industry consolidation prior to then?
To start off, I think a lot will also, of course, depend on what the Bitcoin price is at that time. But barring that, I think a lot of the consolidation we'll see will happen over the next year. We've started to see that now, and I think to some of the high-cost producers while they started to have in the past few months have started to turn negative on their operational cash flows. When they stop operations or when they go bankrupt or when they sell their assets, it's not always immediate. There's a lagged effect. Hash rate does follow Bitcoin price, but there is a lag. And I think we will continue to see consolidation, and that'll start to pick up over the next few months. And I think some of that will be through M&A, but I think a lot of it too will also be through asset infrastructure acquisition. Thinking of why some of the companies that stop operations, of the reasoning of why they would stop their operations. And some of that can be typical with conditions affecting their business, but also to where they're operating. And where they're operating, it might not be capital efficient enough to continue operations there. So it wouldn't clearly make sense to acquire the business and continue operations in the same location. But I think what we will see is some of the companies that are better positioned to expand during the crypto winter, pick up assets and infrastructure, miners, and equipment to expand and grow their operations. And I think too that they will tend to be better positioned as well to withstand the next halving. I think a lot of miners too, that their cost of production, there's a wide range depending on the hash rate efficiency and the machines they're using and the cost of electricity. But for many miners, that ranges typically between 2 to 4 cents per terahash per day, and there are a few others that are a bit higher than that.
Thanks. And I want to touch on financing here. We have a minute left or so. Let's go to Fred and Jaime on this one, because you're both miners that were able to execute sizable ATMs over the past 6 months despite the poor macro environment. Do you expect this to delay consolidation as miners use this capital to fund cash OpEx, or do you expect miners to turn off rigs if they are operating with cash OpEx above current hash price and revenue?
So just for the benefit of the audience here, ATMs are not cash machines, though in a way they are. It's called at-the-money offering. So as a public company on the NASDAQ in the US, you have the ability to essentially issue a certain amount of stock based on the net asset value of the company. And you're essentially, instead of going to an investment bank and doing a directed offering where you place it with a particular investor, you're taking shares and having essentially the bank just sell them into the market at whatever the price the market is, as just somebody who's essentially selling stock. And it's a good way to, over the course of a year, generate a nice amount of equity inflow without having to do directed or placed offerings.
So it's like an equity-based cash machine.
Correct.
cash
You
machine.
put stock in, you get cash out.
There we go.
So that's what an ATM is. I think, you know, we were lucky in that we started using ATMs in 2020. Our market cap grew, you know, at its peak last year was about $8 billion. And we were able to put in place another ATM this spring that we've been using as a way to help cover certain costs. Again, like Jaime, we don't sell our Bitcoin, so we have to cover our operating expenses either through equity or debt, and we prefer not to use debt for all the reasons that are quite obvious there. So I think that that gives companies like Jaime and ours the opportunity to fund operations, even though it might not be, you may not be generating as much revenue from mining because you may be curtailed or not, but at the same time, we're certainly very happy that all our expansion was already funded last year, so.
Yeah, but the key for a successful ATM is you really need to have the liquidity in your stock in order to be able to execute. And with the conditions as they are today in the equity market, there are very few public mining companies that have the kind of liquidity that you really need for an ATM program to be successful. Luckily, Fred and I are two that do have that liquidity. But I think that's one of the challenges that the smaller miners with that liquidity have. They really have a hard time raising equity through any means.
Definitely the barriers to entry to tapping the equity markets have gone way up. Right?
All right, well, thank you, and appreciate you all listening to this.
Thank you.